Hello, this is J. Mike Perkins. I've been a mortgage loan officer for 29 years. And based on my experience, if there is one part of the mortgage approval process that borrowers tend to not understand, it's this: credit scoring. So in this short video, I'm going to explain it to you. First, I'm going to go over some background, tell you how in the world we got to where we are today. Second, I'm going to answer the question, why are the credit scores that the mortgage company gets when it pulls its credit report different than the credit scores you see yourself when you pull a credit report off the internet? Third, I'm going to go over how credit scores are calculated. And finally, I'm going to give you some good practices, some things which should increase your credit scores, and discuss some mistakes that would likely make your credit scores worse. The road to credit scoring began in the 1800s, when individual merchants that offered credit to their customers started keeping a list of people that did not pay their accounts. Soon, they started to share that information in a small network. Then it was decided that there needed to be some entity in the middle to keep track of it all. That became known as the credit bureau. Credit bureaus were small, local, regional operations until computers came along, and then everything changed. All of the small local credit bureaus went through a very long process of mergers, etc., until finally we ended up with the three national credit bureaus that we have today: Equifax, TransUnion, and Experian. Secondly, these computer tapes changed everything, because now the way the system operated was this: individual credit card companies, auto lenders, mortgage lenders, once a month and usually on the same day each month, would send one or more of these computer tapes to the credit bureau. These tapes contained current balance and current payment history information on every single account they had in their system. Now, with this much information, a computerized credit scoring system was possible. When the mortgage lender goes to qualify you for the loan, there are four main things that they're going to look at. They're going to look at your income, your payments, your savings, and your credit. Prior to credit scoring, these three things had a number associated with it, but this last one did not. The way the system worked was each individual mortgage company had its own credit grading system. The problem was the different systems produced different results, and mortgage loans were being underwritten to different credit standards. The answer to these problems was seen as credit scoring. There are many reasons the industry adopted a credit scoring system, but I'll give you two big ones. Number one, credit scoring treats everyone the same. When the computer goes to calculate your credit score, it knows nothing about your race, your sex, your age, your marital status. None of that information is considered in the credit scoring formula. Therefore, the result is considered to be unbiased. Secondly, having an accepted common standard for credit made it easier for the industry to package and resell your loan in the secondary market. When it came time to adopt a credit scoring system, the industry did not have to invent one. It just used one that was already out there and being used in the credit card industry. It was from the FICO company. What is FICO? The name FICO refers to the two people that formed the company. The first one is named Bill Fair. Bill Fair was a computer expert. He teamed up with another guy named Earl Isaac. Earl Isaac was a statistics expert. And together, they formed the Fair-Isaac Company, known as FICO. And the FICO company went on to develop the credit scoring system that we still use today. As a mortgage loan officer, one question I get asked all the time is this: why are the credit scores that the mortgage company gets when it pulls its credit report different than the credit scores that I see when I pull my own credit report off the internet? The answer is each uses a different credit scoring formula. To date, the FICO company has developed a number of different FICO credit scoring models. I counted over 20. Some of them have names, some of them have numbers. The most popular one right now is FICO 8. That's what most major credit card companies use. And when you go in to pull a credit report yourself off the internet, you are almost certainly seeing FICO 8 scores for each of the 3 bureaus. Mortgage lenders don't use FICO 8 scores. For your Equifax score, they use FICO 5. For your TransUnion score, they use FICO 4. And for Experian, they use FICO 2. There's no easy way for you to convert your FICO 8 scores to an accurate 5, 4, or 2 score. Based on my experience, and there are exceptions, but generally speaking, your FICO 5, 4, and 2 scores are going to be slightly lower than your FICO 8 scores. The exact amount can vary. However, a 20-point difference is not at all uncommon. FICO won't tell you exactly what the difference is between FICO 8, FICO 5, FICO 4, and FICO 2. But based on my experience, all of them are similar, but they may treat specific events differently. For example, if you made a late credit card payment this month, you may see that one FICO credit scoring model drops your score 30 points, but another one might drop your score 40 points, and a third FICO model might drop your score 50 points. These are the reasons that the credit scores the models produce are not the same. I can tell you that in general, if your FICO 8 scores are going up, especially if by a lot, then your FICO 5, 4, and 2 scores are also going up, but you just don't know exactly what they are. It is possible for you to purchase your FICO 5, 4, and 2 scores directly from the FICO company through its website, myfico.com, but it'll cost you money. Mortgage lenders always pull a credit report from all 3 bureaus. The credit score that they use is the one numerically in the middle, regardless of what bureau it comes from. For example, if the mortgage company's credit report has an Equifax score of 600, a TransUnion score of 595, and an Experian score of 620, the mortgage lender would use the 600 because that's more than the 595 and less than the 620. If you only have 2 credit scores, the mortgage lender is going to use the lower of them. Although FICO will not tell you exactly how credit scores are calculated, they have released their factors, which show you the most important things that make up your credit score. The most important one is your payment history, and this makes perfect sense because the whole goal of credit scoring is to try to predict how you will pay your bills in the future. So it makes sense that the most important thing is how you've paid your bills in the past. It's important to remember that recent information, good and bad, always has more of an effect on your credit score than older information. You've got to have a certain amount of credit history on your credit report to generate a score. And if something is not on your credit report, it doesn't affect your credit score. The next most important factor is so-called amounts owed. In my experience, this is mainly talking about the balances on your credit cards relative to the credit limit on each individual credit card. It works like this. If you owe more than about 30% of your credit limit on any credit card, they'll start taking a few points off. And the higher you go on your credit limit, the more they take off. And in reverse, if you owe about 30% of the credit limit on a credit card and you decide to pay that down to 0, you may not see any increase in your credit score, or it'll be a very small amount. I get this question a lot. If I have a car loan, which is an installment loan, and it's a 5-year loan, and I pay it off in 3 years, will that boost my credit score? While there is absolutely nothing wrong with paying your car loan off early, in my experience, paying an installment loan off early will normally not increase your credit scores. Approximately 15% of the score is how long you've had your credit open. Let me tell you where this can be an issue. Let's say you have two things on your credit report. One is a credit card that you've had open for 30 days, and the other is a credit card you've had open for 10 years. If you close that credit card that's been open for 10 years, you can lower your credit score in this situation because you would be drastically reducing the average amount of time that your accounts have been open. About 10% of your credit score is the so-called credit mix. FICO wants you to have some installment credit like a car loan and also revolving credit, which is a credit card. If you don't have any recent active open revolving credit, FICO will oftentimes lower your credit score. About 10% of your score is so-called new credit. What this is referring to is the number of inquiries you've had on your credit report in the last 12 months. If you've had too many inquiries, FICO will start taking a few additional points off for each one, usually somewhere around 3 to 5 points. What's confusing is FICO doesn't tell you how many inquiries are too many. It's important to remember a couple of things. When you check your own credit report, it is not an inquiry. It never shows up, and it will never lower your credit score. And finally, FICO accounts for people that need to shop for a mortgage. The first mortgage lender that checks your credit report, that will be a hard inquiry, and that could lower your credit score a few points. But each additional mortgage lender that checks your credit within a 45-day period, each one of those inquiries should not lower your credit score. If you're trying to increase your credit scores and you don't have any open credit cards, understand that it can be very difficult to do and it can take a very long period of time. If that's your situation, almost always, the single best thing you can do is go and open a new credit card and then pay it on time. If your credit scores are low, you may have to get what's called a secured credit card. It's when you put down a deposit, typically something like $300. Then they give you a credit card with a $300 credit limit. They don't make the payment out of your deposit. They just hang on to that in case you default. In every other respect, it's just like a normal credit card. You get a bill every month. And the main thing to remember is that a secured credit card will help your credit scores just as much as an unsecured credit card. If you're about to go apply for a mortgage, it's always a good idea to pull a copy of your own credit report and just make sure that it does not contain any mistakes. If you've got several credit cards where the balances are above 30% of the credit limit and you're about to apply for a mortgage, then if you have the money available, it might not be a bad idea to pay those accounts down to somewhere around 30% of the credit limit. You might get a quick increase in your credit score, and you could get a better interest rate. I get this question a lot. What if I get added as an authorized user on someone else's credit card? Will that help me? Well, it won't help you as much as if the credit card was in your own name, but it could help you if you are added to the right credit card. What is the right credit card? It's going to have three characteristics. It's going to be something that's been open a long time. It's going to be something that has an excellent payment history. And it's going to be something that has a balance that is somewhere around 30% of the credit limit or less. If you can get added to a card like that, then it might help you. If you get added as an authorized user on a credit card with a bad payment history or one that's maxed out, it can easily lower your credit score. If you have several small medical collections that are recent, something like $200, $300, then oftentimes, if you call the collection agency on a small medical collection, they will agree to remove it if you pay it in full. And if you can get a negative item removed from your credit report, normally that will increase your credit scores. Don't open a new credit card to build your credit and then pay it late. If there's any question about you making the monthly payment on time, set up an automated withdrawal to come out of your bank account to make sure that at least the minimum payment every month is paid on time so that card is not reported late. If you're going to need a mortgage sometime in the foreseeable future, don't pay cash for everything. Because if you've got nothing on your credit report, you are not going to have good credit scores. Don't think you can get good credit scores simply by paying off all of the old collections on your credit report and not opening new positive credit. The reason is, if you pay a collection, it is still a derogatory item. Yes, a paid collection is better than an unpaid collection, but if the only thing on your credit report are derogatory items, even if they're all paid, that's not going to get you a good credit score. The only way you're going to get a good credit score is to go open new positive credit and then pay it on time. Beware the curse of the $200 department store credit card that you immediately charge $190 on, because now you're maxed out and they've taken some points off your credit scores. If you've got multiple credit cards that are high on their credit limits and you're trying to increase your credit score as quickly as possible, then don't make the mistake of taking all of your money and paying one of those credit cards all the way down to zero and then leave the others maxed out. Normally, you're going to be better off to spread your money around and bring all of the balances relative to the credit limits down. Don't depend on credit repair companies to fix your credit. There is no one that can write a magic letter that will make bad credit that belongs to you and that can be verified disappear off your credit report. What the credit repair company is going to do is this. They're going to dispute large numbers of negative items on your credit report. When an item is in dispute, it is temporarily removed from your credit scoring. So naturally, if a bunch of bad stuff is pulled out of your credit scoring, the credit scores are going to go up. But as soon as the disputes are processed, the items are added back into your credit scoring and it goes back down to where it was before. Also understand this. If a credit repair company is lucky enough to get an item removed off your credit report, say the collection agency or the creditor did not answer the dispute within the 30-day period, if that creditor finds the item the next month, they can put it back on your credit report. There is no such thing as a permanent deletion for credit that belongs to you and credit that can be verified. If you have a credit card and they offer you an increase in your credit limit, it will normally increase your credit scores to accept it. If you're building a house, understand that there's a long construction period. It might take 8-9 months. And during that time, the credit report that the lender has is going to expire and they're going to have to pull a new one. Don't make the mistake of messing up your credit during the build time, then waiting to the end, then the lender pulls a new credit report, and now you don't qualify for the mortgage. If you've got federal government guaranteed student loans, don't allow those accounts to go into collection. If you do, now you've got a federal government collection on your credit report, and it is very difficult to be approved for a mortgage. The only way out, assuming you can't pay the loans off in full, is to get into a rehabilitation payment plan. You have to complete that plan before they will return those student loans to a positive status. And it takes about 9 months to complete a rehabilitation payment plan. And while that's going on, there's not much you can do as far as being approved for a mortgage. Finally, don't give up. Realize that credit scoring is something that you can control. Also, realize that the most important thing in credit scoring is what you do now, recent items. Bad stuff that happened to you in the past is not as important, and the more time that goes by, the less important it is. Thank you very much for listening. I hope I've taught you something. This is J. Mike Perkins.